All right, welcome back to the program. My guest is joining me right now. Aisen is the IMF resident representative in Nigeria. Hello, Ari. Welcome to the program.
Thank you.
How are you doing today?
Good. It's a pleasure to be here.
Fantastic. Nice to have you. Ari, I have read so many pages. I have not read it to the end because I'm in the middle of reading many things. But the few things that I saw, the Sub-Saharan Africa Regional Economic Outlook that the IMF released, just in 1 minute, shed light on that report. For those that are watching now and don't even understand what that report means, what does it mean and why is it necessary that we should be interested in what the IMF is saying about Sub-Saharan Africa at this time?
Okay. The report is titled Living on the Edge. And the reason for that is that we are certainly at a quite challenging time for the global economy and for the region. I think people need to be prepared for this new environment that we are. So basically, growth is not going to be as strong as we thought perhaps a year ago when we were recovering from the pandemic. And with that comes challenges for stabilizing the economy. Inflation has been very high in various of our countries, and debt positions have increased. So it's going to be challenging at the same time that the policy space is constrained. You have real challenges coming from climate, as we saw here in Nigeria, but on food security, which is a top priority for any country to ensure that there is. So challenges are there, policy space is constrained, then I think it's important to understand what's possible to be done in the various economies, and it will depend a little bit on each economy, considering the available space, what they can do.
Which of the challenges do you think is most distressing? Out of all the challenges, the climatic change challenge, food security, inflation, the inflation also occasioned by food insecurity, or Russia-Ukraine war, as it were, which of these challenges the public policy, policymakers having tight fiscal space, in the case of Nigeria, for example, revenue, low revenues. But if you take a look at it, give me an optic view of which of the challenges is most distressing for African countries?
To me, there is no doubt that it's the food issue. With food insecurity, this is a top priority to resolve for Africa, in fact, for any country. Morally is the right thing to do, but beyond the moral aspect, if, for example, children, and here our colleagues with UNICEF, we work closely, if there is malnutrition and until the early ages there is no food for children, they cannot become productive adults. So to me, it's a strategic objective of any country to ensure that there is enough food for its population. Of course, with that, then after this top priority, the fiscal situation, raising more revenues, controlling inflation through tighter monetary policy, ensuring macro stability is also quite important. And looking to the future, how to ensure growth that is greener, that is allow the country to produce more food, which is needed, but at the same time ensure that the country is adapted to the challenges offered by climate change.
Now, the IMF in this report said we're living on the edge. Are we going to fall off? And when are we going to fall off? Oh, I'm sounding like an angel of doom. But you're living on the edge, so you could just like with a tip, you could fall off. Or with an adjustment too, you can find your balance.
Right.
So which one of it is it for us? Are we falling off? Are we almost falling off? Or are we going to, take a step back to balance?
Well, certainly I hope that we don't fall off. and we will do anything that it's possible to support our countries not to fall off. That includes solidarity and trying to, for those in need, to create the policy space through our own financial support. But it will also depend a lot on the policies adopted by our countries. And you know, we are in a time in some countries where, for example, here in Nigeria, we are now with very high levels of oil prices. So the economy should benefit more from those. So why is Nigeria not benefiting as much from oil price being so supportive in terms of revenues, in terms of the balance of payments? So I think that each country needs to make sure to take advantage of the conditions in place to rebuild buffers, to create space and avoid falling off the cliff, as you were saying. We'll do our part, but the biggest part will always lie on the policies of the governments of our countries. Some of them will have to for example, renegotiate their debt commitments because they don't have space enough in their budget to service their debts. So the debt became unsustainable. So we have 6 countries in that situation, that distress. So each country has a different challenge on the macro, but I certainly hope with the solidarity of the IMF and other development partners that our countries do not follow off the cliff. And starting with boosting food security, to me that's a top priority. Many countries have done it, even Brazil, which I know a little better. The situation improved over several decades with more food production, and there are still challenges there as well, but we have made quite a bit of progress compared to the 80s, for example, on that ground of food security.
Now, you're addressing the key policy areas which you've taken a look at. The first one is the food security. There are some other key policy areas which in your reports you addressed, managing the shift in monetary policies. You also talked about greener growth, setting the stage for sustainable and greener growth. Then what's the fourth one? I'm trying to remember. The fourth one, consolidating public finances. Right. Let's talk about the shift in monetary policies. What did you mean by that?
Well, inflation is very high. In Nigeria, for example, it's at a 17-year high. So when inflation is very high and is disseminating among various items in the basket of goods of our countries, then it means that probably there is quite a bit of liquidity in the system, meaning a lot of money was pumped into the economy and prices are rising. So it's very important to tackle this by reducing the liquidity or the money in the economy so prices don't continue to escalate. And this is what we mean by shifting. In some countries, that inflation is gallopant and the monetary frameworks are not very reliable or credible, you need even to be more decisive on, for example, raising interest rates or containing the pressures on the liquidity in the system that is driving inflation. At the end, inflation in the medium to long term, inflation is always going to be a monetary phenomenon. Without money, there is no inflation. Well, so money has been, liquidity money has been issued for inflation to start increasing. So it's natural that central banks will then try to restrict liquidity so that this price acceleration can be moderated, yes.
Now, Ari, I'm trying to juxtapose what you've just said with the case of Nigeria, for example. Taking a look at Nigeria's inflationary environment, you said without money there can be inflation. But Nigeria's inflation is also thought not to be a monetary phenomenon, 100%. Why? Because perhaps there are structural factors, there are legacy factors, such as farmers can't get access to their farms. We have insecurity issues, the Russia-Ukraine crisis, for example. We can't get food that we used to get from those 2 key countries and all of that. Yeah, you don't have good roads as well, so that will feed into the logistic costs of farmers getting, you understand what I mean?
Absolutely.
Harry? So In that case, would you say that inflation is a monetary phenomenon in Nigeria?
You know, that's always a very interesting discussion to have, and I don't want to be too academic on it. The thing is that you always have supply side problems or structural conditionings that may drive inflation. And if it's true, if they repeat it successively, prices will continue to go up because they are successfully, not successfully, they are succeeding one after the next. So you have a sequence of shocks that are driving prices up. But I think that some thought needs to be given to the fact that in some cases, the prices that are affected by the shocks are not the entire basket of goods. Prices of other items. Like, for example, you have the Russian-Ukraine war. It's natural to expect that the price of bread, because of wheat prices, they will go up. But that doesn't mean that the price of the haircut should go up at the same rate that the price of the wheat. Or it doesn't mean that the price of other food items that are not complementary to wheat or substitute to wheat should increase at the same level. For example, the price of lettuce or some other vegetables or fruits that you produce a lot. So when that starts happening and you have a dissemination of price increases among all items in the basket, particularly those that we consider core inflation, if you exclude the most volatile items, food prices and energy, that tend to be affected by those shocks, by those structural problems, supply issues that you mentioned, then I think it's a diagnostic of a deeper problem that is more related to the amount of liquidity in the economy than the shocks themselves. And in fact, inflation in Nigeria had been, in fact, the target from 8 to 10%, but now we are at a 21% as last month. So clearly inflation has escalated. Now this is a global phenomenon. Many countries have inflation much higher than they used to be, including advanced economies, because of these shocks. The question is, what do you do with that? And I think the central bank has responded that question by tightening already 500 basis points this year. It may need to go further because inflation is high.
So it may need to go further. You're saying that the Central Bank of Nigeria's MPC should increase interest rate to tackle the inflation.
If inflation doesn't start decelerating in the next months, I'm sure the central bank will be concerned and they will take the conclusions that maybe future tightening will also be needed. Now, it's very important in the context of Nigeria, considering the macro monetary framework that is used, that at the end of the day, what you want is the monetary mass or the liquidity in the system to contract. That is not only going to be achieved by raising the monetary policy rate. Two additional steps are very important. For example, the central bank does quite a bit of quasi-fiscal operations. For example, development finance, credits to agriculture, manufacturing. Well, scaling that back so that liquidity doesn't increase further is an important thing. Critically, the financing of the deficit in the last years has relied in some part...
That's government deficit?
The government does, the fiscal deficits, has relied in some part with monetary financing from the central bank. That also increases the liquidity in the system, the pool of money in the system, that cannot be easily mopped up. When I say mopped up, the central bank needs to sterilize that injection of liquidity and bring it back. If it's not able to do, then liquidity increases and press prices. So at the end of the day, what we need is that the monetary growth in the economy to decelerate. It has been very high despite the increases in the MPR. So I think then the central bank understands that and is trying to fight inflation. That became a priority compared to earlier periods, and we had been supportive of those periods, that the central bank was trying to support growth right after the pandemic because, of course, it was a difficult environment and efforts needed to be put in place to support the economy.
Let me play devil's advocate, and I'm just thinking that at the last, we are coming down now to Nigeria. At the last MPC, the Monetary Authority raised interest rates to 16.5%. It surprised the markets, though, for a few people. Some people thought that the MPC was going to hold the rates. But the question really is that with this stubborn inflation we've seen, I think in the history, at least for the past few years now, this is the first time I'm seeing inflation accelerating at this pace. We've not really had it this bad in terms of acceleration, quick acceleration. So in the looking at this thing right now happening, accelerating inflation, stubborn inflation, are you also taking a look, or is the IMF taking a look at if inflation, this accelerating inflation, stubborn inflation, is not responding to accelerating rate hikes too? Because we've seen 5 times this year that interest rates have been hiked by 500 basis points. Yes, I think so, either 5 or 4 times. I think 5 times. So what is the option? I heard you quite and clear. Quasi-fiscal policies that the central bank has put its hand into and all of that, reduce government debt. But is there any other thing that the monetary authority can do to make inflation decelerate?
The first thing I want to say on this, Nancy, is that it's too soon to actually judge if interest rate increases are going to have an effect in prices. Because monetary policy works with lags. You raise interest rates today, the effect of that in the markets, in lending rates, in credit, may actually take at least 6 months. So all the efforts put in place by the central bank will probably working through the system to help decelerate inflation going forward. So we shouldn't expect an immediate impact. But the central bank, of course.
How long should we expect?
Well,
because they meet once in 2 months. How long are you looking at that? We may see a permeation of these policies.
That varies country by country, and there are various factors that condition the speed at which the transmission from interest rate hikes to the real economy take place. In advanced countries, that can take from 6 to 12 months. In countries like Nigeria, where the transmission may be slower for various reasons, particularly the depth of capital markets is not as deep as in other countries, it may take even further. And it may require higher increases in the rates for the same effect to play out compared to an advanced economy. This is why, for example, several times you see in the US or in the European context that interest rates increase by 25 basis points, 50 basis points. And in countries, emerging economies, typically the same rate needs to be increased by more for the same effect to play out because of the transmission. So I think it's too early to say that interest rates will not have an impact. We should certainly monitor closely and be ready to raise more if inflation persists and is stubborn. Typically when inflation increases, there is some inertia and expectations and it continues a little longer because those agents in the economy are already used with price increases. There is the issue of the exchange rate, the foreign exchange. There is a channel when you have a lot of liquidity. So maybe foreign exchange is not as available, that people go to the foreign exchange market. It's very important to monitor the channels and make sure that there is less naira around floating for inflation to start reducing. The challenge there, Nancy, and I must say, is that when you have supply shocks like we were discussing before, it's the most difficult situation for the central bank. Because in those situations, the economy is already suffering a little bit from those shocks. And at the same time, you have inflation. So then central banks face this trade-off. How much tightening can I put in place when the economy is not...
needs to grow.
For the economy needs to grow. And that is exactly where the central bank doesn't like to be and needs the support of other policies to strengthen the economy.
You spoke earlier on about the fiscal deficit. We've seen the central bank borrowing to the government just a few days ago. So Nigeria's debt increased from 42 trillion naira to 44 trillion public debt. Are there other options for the fiscal authority to take to reduce this fiscal stress? You know, to also reduce that central bank is not lending, which is even more than its statutory limits. Now, it shouldn't be lending that much to the federal government. That's A part of the question. Sorry, Ari. The B part of the question is, with all these challenges that we're talking about, what is the IMF doing to support countries that are already challenged, such as Nigeria? I know the SDR was last year. Was it last year or 2020? Last year. IMF gave countries some monies, you know, and all of that. Is the IMF thinking of support to challenge countries, Nigeria inclusive?
Okay, so in terms of the deficit and how to finance, I think it's important to take one step back and see why do we have deficits. And the first line of action, as we discussed, in fact, last time I was here, is revenue mobilization. The country needs more revenue. Luckily, the non-oil revenue has been increasing, and this is not luckily, actually. This is because of policies adopted at the Ministry of Finance level to mobilize more non-oil revenues. I think what didn't happen this year was in the oil sector.
It went down.
The revenues were not commensurate with even high oil prices because production didn't accompany, and because also the fuel subsidies took a big chunk of it. So the country could not benefit from the oil boom in terms of the revenue increase as it should, like other countries in fact benefited. So there, my answer to you is that if you just eliminate subsidies out of a 6% of GDP deficit, 2% of the deficit is because of fuel subsidies. So you cut 1/3 of the size of the deficit just by taking that measure. That's why it's very important that Nigeria actually takes that decision sooner rather than later. So so that reduces the financing needs of the country significantly because the deficit will be much lower. If you raise revenues more, then you reduce the deficit even further. And reducing deficit further, if the economy is growing reasonably well, the debt to GDP ratio is not going to continue to increase. It's now at a moderate level, and you have more revenues to service the debt. So you have the fiscal space. So I think that the discussion of debt in Nigeria is a discussion about how to mobilize more revenues and how to make sure that you can do good spending, not through the few subsidies. With the poor people, of course, you need to target with good policies those who need, but not universal anymore type of subsidies. Otherwise, that will prevent the country to benefit from the current positive global environment in terms of the commodity prices. Of course, if the economies of the world next year, we are projecting a declining growth in the world, and commodity prices also start to soften, then it will not be as good for emerging economies, commodity producing countries. But I think this year has shown that even if you have high commodity prices, because of the high level of subsidies that are universal, you are being prevented to rebuild buffers that were used during the COVID-19,
yes.
which you should have used.
And it's 2009 financial recession that plagued the world, but Nigeria was a bit insulated because we had buffers. Right. Now let me come back to the
just to finish on the IMF.
Yes.
What are we doing? What are we doing?
Yes, support.
So in various economies who have a balance of payments needs, we are trying to put financial programs in place, reforms and assistance with finance, so that to mitigate the effects of some of the adjustments that these economies need. In other countries, and Nigeria is a country in question, we are putting a lot of effort on capacity building, particularly on tax administration and tax policy. And we have recently even brought a resident advisor on tax administration to support this effort according to in line with the SRGI, the
Strategic Revenue Growth Initiative of the Federal Ministry of Finance.
Exactly. So how to support FIRS, customs, to actually deliver on the strategic need that the Ministry of Finance is communicating. So we are trying to work together by beefing up the capacity building efforts, training, and resources to the country to increase the level of.
So the support is coming in
at
terms
the
of
public
technical
servants
support now,
Yeah,
not monetary support for now.
and policy advice.
And policy advice. Okay, how much of a challenge is Nigeria's debt? Really, we've heard so much. Okay, your debt to GDP ratio. Our debt to GDP ratio is good, but we'll also be quick to always remind the minister at every time that is debt to revenue ratio is also debt to debt servicing ratio, as it were. But the Minister of Finance has always said, Nigeria, that we have a revenue problem. How much of the debt, how much of the challenge is our debt? Is our debt really 44 trillion naira now, public debt?
You see, this economy is a big economy and it grows at a reasonable level, and it can accommodate that level of debt. So it's not a solvency problem as some of the countries that we know need.
That's for Nigeria?
For Nigeria.
So we don't have a solvency problem?
Not a solvency at the moment. Solvency problems would happen when the country is no longer able to pay and is in a trajectory that we consider unsustainable, meaning that the growth rate is no longer able to compensate the debt increases, even because of the debt service. Because the debt stock increases with the fiscal deficits that include the debt service. So if the debt service is increasing and putting the country in a trajectory that is not able to grow to service its own debt, then it's unsustainable, and then it's a solvency issue. So we are very far from that type of situation here. What we have is a liquidity strain that can be resolved by bringing more resources into the treasury. And the way to do that is by collecting more revenues. If you have more revenues, you'll be able to service that debt. And how to bring more revenues? One is eliminating the fuel subsidies so deductions don't happen and oil revenues can increase. Other is by producing more oil in the case that we are discussing, so oil revenues can increase with the volume of production. But all types of initiatives in the Finance Act are being discussed, you know, excise taxes, other revenue vehicles are important, improving the administration, increasing compliance by taxpayers for paying their due debts, and making sure that the quid pro quo, that funds are used properly to increase the trust between taxpayers and the government, so that you can enter a positive spiral of more revenues and better use of those in the provision of public goods and services. Nigeria is not a case of too little spending. It's a case of too little revenues. It's not about cutting spending, really, because spending in health, education, social protection is very, very low. It's even lower than what is being spent in terms of fuel subsidies. So it's a question of raising more revenues. It's a consolidation of the public finances through stronger revenue mobilization.
Okay, just before we go, we're still talking about Harry, you wanted to run off very quickly, but just before you go, still talking about this debt issue. What do you think is the impact of the strong dollar on servicing, not just even Nigeria's debt, but other SSA countries, sub-Saharan African countries? We've seen the impact of an appreciating dollar. In Nigeria, we have, of course, the parallel market. In other countries too, for example, Ghana. Just I think 2 days ago, was it yesterday, Ghana's currency started doing well. But in the past few weeks, or even in the past few months, Ghana has really been bleeding, other countries too. So what do you think is the impact of a strong dollar on debt servicing?
This is an excellent question. And we have a chart where we show that the debt level for the region is reaching, as a share of GDP, pre-HIPC, pre-highly indebted poor country initiative, that there was debt relief for various countries. So we have reproduced, unfortunately, the pre-HIPC debt levels. One important aspect of that the composition of the debt also changed. We used to rely more on multilateral, cheaper and longer term
Yes.
debt. And now we rely more on euro bonds and domestic bonds as well. That's positive for the capital markets. But to your specific question, and I think it's very important to notice the composition, countries that have a very high share of its debt denominated in foreign currency, every time that the currency depreciates, it puts an additional burden
On the local
in
currency.
their not only in the local currency, in their fiscal resources,
Yeah.
because you need to raise more of the local currency to service that debt.
Yeah.
So it constrains the fiscal space. So when we talk about debt risks, the composition, not only the levels, as we were discussing before, the composition, the diversification among creditors, all those aspects of the profile of debt of the country take a very important role. And in your, particular to your question, if you have a high share of debt that is external and denominated in foreign currency, certainly if your currency depreciates, your burden to service that debt will increase.
Okay.
Is that clear?
Yes, it is very clear. And I hope it's clear to my views too.
I hope to.
Just before you go, something come
Sure.
into my head. Article 4 consultation, I think.
Yes.
The next one?
So we just finished about how many weeks now? 2-3 weeks
2 or 3
ago.
weeks, yes.
And we have published a concluding statement on these discussions with the government. They were very good and cordial as always. The next one is going to be only in 1 year, but we have actually put all those things that we have been discussing today, the revenue-based fiscal consolidation as a policy advice, tightening monetary policy and making inflation the primary goal of the central bank, reducing inflation now is critical. Food security issues. We even had a very nice presentation on food security and food insecurity in Nigeria and Sub-Saharan Africa that was presented by one of our economists to various stakeholders, particularly in the government, to highlight the importance of handling the issue head on, because without food, I'm already feeling a bit hungry, even with all this discussion. We all need.
Yes, we need a bit of sugar
in
our system, supplied by food.
Absolutely.
So, thank you very much, Harry.
Thank you.
I wish you compliments of the season in case we don't see before Christmas. Have a fantastic holiday, and we're hoping to resume again next year. But I hope that we'll be saying, it will be brighter things to talk about. I hope so.
Absolutely, Nancy. It's always a pleasure to be here with you. It's fantastic. And to the audience who is watching us, I hope that this was illustrative. And just to say on a positive note that Nigeria remains a very, very strong economy with huge potential. The question is what policies can actually make that potential come to fruition. And we are here to support and as partners of Nigeria and of Nigerians to make that happen, particularly towards 2023. So greetings for the season.
Greetings too for the season. Thank you for
holidays.
coming.
Thank you.
Thank you.
Thank you.
All right, I've been speaking with Aisen. He is the IMF Mission Chief in Nigeria. Let's